We're going to transition into the next phase of our analysis where we actually looked through our 2018 numbers in our business case and we kind of understood where the challenges were. And now we're going to now what we've done is we've had a year with this client to where we were able to improve upon their financials, we're able to improve upon the accuracy, we're able to get the financials accrued so that all the revenues are being booked in the period in which the revenue is earned, and we're booking expenses when those expenses are incurred, not paid. So what that's going to do is that's going to start to smooth out some of the trends that we were seeing. We should start to see a stabilized gross profit margin, and then we should start to better understand the attributes of each expense, whether it's a variable expense, whether it's a fixed expense, and what that has to do on the overall business model. And so in 2019, what we were able to achieve is to where we really now understand the business model. We understand the relationships between costs and revenue. We understand how this business model scales. We understand the seasonality of the business model and what challenges might incur in low revenue months, and also what opportunities that we have in the high revenue months and how to best take advantage of those. Okay, so this is the third step to our financial analysis. Now, where we've gone with this slide is we've been talking about the 2018 numbers. And so the 2018 numbers were historical. We had already filed taxes on those financial statements, and so we didn't really make any effort to go back and clean up what was in 2018. But what it helped us understand is what changes we needed to make as we went into 2019. And so once we got into 2019, we did a couple things. First of all, we set some forecasts, and we did that based on trends that we saw in the 2018 statements, but then we improved upon those forecasts over time through 2019 as we felt like we got a better grasp of the revenue trends and the expense trends. The other thing that we've done is we've moved to an accrual basis accounting system, and so now what we would expect in 2019 is to see a standardization of margins. And so what happened is the first thing we did is we set a goal for 2019, a revenue goal. And so we started to book that goal, and this was actually these were our 2019 revenue targets right here. And we were able to see where actuals came in and what deviation we had off of those revenue targets. So now we're starting to create a discipline of setting goals and achieving goals, which is really important if you want to be able to have a good narrative to investors. What investors love is they love, first of all, seeing organization. They love to see accuracy. They love to see the ability to forecast with clarity. And then they like to see a history of actually achieving those goals. So they're just not talking about pie in the sky assumptions. They're actually talking about stuff that's grounded in reality. And so, we can kind of scan over, and they had a pretty ambitious goal. And you can see at year end, they had set an original goal and they had fallen short of it. But they still achieved more than they probably would have had they not had any goals. Now, as we get to the cost of goods sold section, what we start to see is now that things are appropriately accrued and we have more discipline. As you recall from the last slide, the cost of goods sold section was kind of disorganized. There were areas that didn't have costs. We consolidated some of the expenses within certain categories, and so now we can see what is our true cost of goods sold, what is our fulfillment center costs, what are our merchant accounting fees, and now we can dig into those, and then we can look from month to month as a percent of sales and see how what the variance on those are, and to the degrees that there's significant variance, we know that maybe there's something off. But as you can see, what happens is when we standardize our cost of sales, we start to see a gross profit margin that's pretty consistent. Like, we bounce a little bit around it. We have a target gross profit margin of 66%, and then we are tracking the deviation from that plan. And the standard deviations are actually pretty narrow, and so we're able to kind of understand what our business model really looks like. And once we are able to understand that, then we can start to forecast with more certainty. And understanding, of course, that these cost of goods sold will always vary a little bit because the product mix we're selling will always vary a little bit. And so it's never going to be perfect, but what we want to understand is kind of generally where we should be, and then a deviation around where that standard is. And so now we have our gross profit margin kind of dialed in. Now we go down to our operating costs. Now the attributes of most operating costs are that they're fixed costs. And what we've done here is we've highlighted each fixed cost with this blue bar here. And so, when we start to forecast, what we've done is we have a column here that we start to say generally on these expense categories, they run at this % of sales. However, with certain categories, they aren't forecasted off a % of sales, but rather they're forecasted out of an actual amount. And that's important to understand because how ultimately you generate margin, an increase in a margin as a % of sales, is you get more out of your fixed costs. So you do more with less. And so these categories are important to understand where they are, these fixed cost categories, because we want to create a lot of discipline over these categories. So for example, rent. We know that we standardize on a certain amount over time, and to the degree we can get more revenue out of that same fixed cost expense, that produces more margin as a % of sales. And so we want to create a lot of discipline there. And as we forecast forward, we understand that at certain revenue levels, these fixed costs will probably step up because we'll have to hire some more people, and then they'll need a bigger space. And so we kind of have that conversation about what that looks like as far as when these fixed costs can step up. But as the other thing is now look what we have. We have some categories, and so we have a financing category. We understand, what our interest expense are, what our bank charges are, and so we could kind of monitor that category and see, what does our interest expense look like from a month-to-month basis. We see all of our total payroll and professional. We have, accounting. We have CFO services. We have legal expenses. These are all people categories. And the reason why I like to see all these people categories grouped in with payroll is at any point in time we're going to have a discussion whether it makes sense to bring a competency in-house or outsource it. And when we make those decisions, we'll be able to understand by looking at our month-to-month how that decision has impacted our operating cost structure. And again, our goal is to become efficient with our costs, to get more with less. And so we're always having that conversation. And so most of these are fixed costs, but we can see how, there are some areas here where our wages and salaries, we took a step up. And there's a little bit of variance in that from month to month. And so that's a conversation that we have. Now, we've got some R&D category. We have a sales and marketing category. This is a real important category because we can understand, as a % of sales, like what do we usually run on a total sales and marketing budget. And this varies a little bit based on our high revenue months. When we have high revenue months, that will go down. But then we can also talk about how now that we understand the seasonality of the business, we can start to have conversations like, okay, in November, we know that that's a really big revenue month. Does it make sense to really lean in with our sales and marketing budget? Because we know people are listening. People are buying during that season. So does it make sense to increase our marketing and advertising spend to be able to capture more of that interest? Whereas, in other months where typically sales aren't as strong, does it make sense to spend a lot on marketing? Because if people aren't listening, is that really going to help, move the needle on revenue much? And so you can see that's the decision we made. As we got into November, we almost doubled our marketing budget. And then as we go up and we look at what impact that was on revenue, we can see, you look at our revenue line, where historically we're kind of bouncing around. We start off kind of slow, the 150, we get to 200. We have a real strong May at 567. And as we get into November, this is a real success story. We have our first $1 million month of the company. And so we realized that November was an extraordinary opportunity, that the customers were listening. We increased our marketing spend, and we were rewarded for that. And so now we look at our operating income over the year, and we can see that we started off, because our business model, just the structure of the business model, we kind of get a sense for how we have to do at least about $200,000 a month to break even. But given the seasonality of the business, we realize that sometimes we're going to come and we're going to have a negative profit margin, operating income or loss. And this is important to understand because, when we started out this year, we started to freak out a little bit and said, we're not doing that well as a percent of sales on our profit margins. Let me do this here. And the question is, when do you hit the panic button? When do you go raise money to be able to address those concerns? And what is something that you would kind of anticipate? So as we look at this, and I highlighted these with some data bars so you can see that we started off a negative 32% operating loss. And so that's a concern. And then the next month we followed up with a negative 7.59% operating loss. Then we had a profit, and then we had another loss. And so at April, at this point in time, we're starting to get a little concerned, because if we look at our total profits for the first 4 months, we're at a negative $56,000. But we know May is a good month, and we were able to kill it in May. We got a 34.42% profit. We made some changes, to some operating costs. And so we had some actual data that could drive some meaningful decisions for the company. And then November, we had a huge month, 41.45% operating income, and for the year we ended up at almost 15% profit, and that was a $606,000 amount, and so that helped us. Now that was a success as a year, and we were really pleased to know how we came out. But the other success is now we have a real good feeling for the competency of our business model. And now as we go into 2020, we can look and say, okay, what is going to be our goal for 2020? And we've decided that we're going to try to shoot for 6.7 million, whereas we arrived at 4 million in 2019. And so we've accounted for the seasonality, and we've broken up that goal out by month. And now we're going to start booking actuals into each month to see how we're coming. We feel like we have a good sense of the attributes of all of our expenses, whether they're variable or fixed, and how revenue growth will impact each one of those cost categories. We have everything grouped to a point where we feel like we can get a good sense for the ROI of all the different spends. And we also get a sense for, maybe we typically start out the year slower, and we know what our big months are and how to take advantage of them from a marketing perspective. We know what our target gross profit margin should be, because we kind of know we bounce around that 66.56% gross profit margin. And now we can forecast out with more certainty and look, as we extrapolate this business model out to a couple years. Here we've got through 2021, and actually we actually have been able to forecast out through 2023, now using that same logic. And so now we have a competent forecasting model. The next slide I will show will kind of get more into the balance sheet and understand the health of the business, and then we'll also talk about some KPIs.